Hello there, and welcome to this Level 2 podcast focusing on Basic Accounting 1. My name's Gareth. In fact, you'll see you've got my contact details there. Feel free to drop me an email if you've got any questions, whether it's about this syllabus or about other general AAT queries. GarethJohn@fi.co.uk. I'm a managing director with First Intuition, which is one of the UK's premier accountancy training colleges. We've been very, very pleased in recent years to win some quite prestigious awards. We were awarded the UK Accountancy College of the Year in both 2010 and 2012. I was very proud to win UK Lecturer of the Year in 2011. We're also nominated for Study Resource of the Year in 2013. Now, the purpose of these podcasts is really to focus on some key technical areas that students sometimes find challenging in some of the key AAT assessments. Since introducing the computer-based exams, you can imagine that the AAT has been able to generate a lot of very detailed data about how students do in each task of each assessment, and there are certain problem areas that students are tending to find more difficult. And so what I'm just trying to do for a short period of time is focus on some of those particularly challenging areas. Well, one highly important area of the Basic Accounting 1 syllabus, and in fact relevant to other units you will see at Level 2 and in fact Level 3 of your studies, is double entry, the basic principles of double entry. And a couple of areas that students do sometimes find quite difficult, which is returns and discounts. Now, before we actually start thinking about returns and discounts, let's just think about the basic principles of double entry. So double entry is our basic process of building up balancing debits and credits. The golden rule is that every debit we post must have a balancing and corresponding credit. Let's remind ourselves what a debit and a credit can actually represent. So the mnemonic I use, and you may have seen before, is dead click, as a way of remembering what debits and credits can represent. So what can a debit represent? Well, following the dead, debits can represent an expense. So if, for instance, I was paying a rent bill, I would be debiting rent expense. Debits can also represent assets. So if I was buying a car, say, I would probably debit the motor vehicle asset account. And debits can be drawings. So if the sole trader, if the owner of the business takes money out of the business, we would debit the drawings account. So that shows what debits can represent. Credits, well, the click side, credits can represent a liability. So if we were to borrow money from a bank, we were taking out a loan, we'd owe the bank that money, we would credit loan account. Credits can also be income. So if I make sales to a customer, I would credit sales. And credits can be capital. So if the owner pays money into the business, if they make a capital injection into the business, we would credit the capital account. Now, thing to bear in mind is this dead click mnemonic is about how we increase each element in our account. So if we're increasing an asset, we debit it. If we're increasing a liability, we credit it. But if we want to do the opposite, if we want to reduce an account, we need to post the other entry. So if I'm trying to reduce an asset, I would actually credit the asset. If I want to reduce the liability, I would actually debit the liability. So remember, the dead click principles are about how we increase any particular account in our nominal ledger. Well, that's the basic principles of double entry. Let's think back to the specific transactions we're going to think about here, which are returns. Now, returns could either be sales returns from customers, where I've made a sale to a customer, but they've not been happy and they've sent it back, or purchasers' returns to suppliers, where I've bought from a supplier, but maybe the units are broken, so I send them back. And discounts, where either I could have discounts allowed to my customers, where I'm letting them off with part of what they owe me, or discounts received from suppliers, where I've purchased from a supplier who's knocking off a bit from what I owe them. Now let's have a look at some transactions, and we'll work on the double entry for each of them. Now you can see here we're going to assume the standard rate of 20% value-added tax where relevant. So the first transaction we've got is a credit customer has returned goods with a gross value of £120, so that's a sales return. Our business has given a £150 early settlement discount to a credit customer who owed us £500. so that's a discount allowed to a customer. We return damaged goods with a net value of £200 to a credit supplier, so that's a purchaser's return, and we received a £300 discount from a credit supplier as an incentive to pay an invoice of £1,000 more quickly. So that's discounts received from a supplier. And for each of these 4 transactions, we're going to build up the double entry. Well, in fact, double entry, hopefully it's something you've already started to practice, and the key with double entry is just to practice till you get it right. So why don't you pause me and start working through the double entry for each of these 4 transactions, making sure that you always have a balancing debit and credit. So whatever you're posting on the debit side will balance whatever posting on your credit side. And bear in mind, you may sometimes have more than one entry on the debit or credit side. So why don't you pause me while you see if you can work through these 4 double entries, and then we can compare notes. Well, starting with the first one, a credit customer, so a customer who owed us money, has returned goods with a gross value of £120. Now, when it says a gross value of £120, that's going to include VAT. And if it includes VAT at 20%, I can establish that the net value of the transaction, well, to go from the gross value to the net value, best approach is divide by 1.2. So I get a net value of £100. The VAT, therefore, on that is 20% of the net, which is the £20 that takes you back to the 120. So it's useful to just analyse that gross value by net and by VAT. Now, because they're a credit customer, they would have owed us the gross value of £120. That would be sitting in the sales ledger control account. That would be a trade receivables balance. The fact they've returned the goods means they're not going to want to pay for it anymore. So the first thing we need to do is we need to cancel the outstanding trade receivable. We need to cancel the sales ledger control account. Now, an amount owed by a customer is an asset of the business. That's something we own. And an asset would be a debit balance. So it would be sitting as a debit on the sales ledger control account of 120. But if they've returned the goods, they're not going to pay for that. So the first thing we need to do is we need to credit the sales ledger control account by the full gross value of 120. Imagine that's reducing the amount I'm owed by my customers because they've sent it back to me now, haven't they? Now, the fact that they've returned the sales, well, I haven't really generated a sale, have I? We would have recognised income in the sales account of £100 on the initial transaction. Got to imagine I wouldn't have taken the whole 120. The £100 net value is my bit of it. The other £20 is VAT I'm collecting on behalf of HMRC. So what we now need to do, well, when we recognise the sales income, it would have been a credit. So what we're now going to do is we're going to debit sales returns by the net value of 100. That's effectively cancelling the income I would have recognised when I first made the sale. And we would have only recognised a credit to sales of 100 for the net value. Now you can see at the moment my double entry doesn't balance. I do need an additional debit entry for 20, which is to the VAT control account. Because when we made the original sale, we would have had the £20, which would have been output VAT. That would have been recognised as a liability that I owe to the taxman, I owe to HMRC. We don't get to keep the VAT, we owe it over to the taxman. That would therefore have been shown as a credit, a liability. But we're not really going to receive that money now, are we? The customer has returned the goods. So we now need to debit the VAT control to cancel the liability we would have had. So that is the full double entry for the sales return there. You can see we've got 120 on the debit side and 120 on the credit side. Well, the second transaction is our business has given a £150 early settlement discount to a credit customer who owed us £500. So they would again have been sitting on the sales ledger control account. They'd have been an asset. They'd have been a debit of £500 in total. But because we're giving them a discount, they're not actually going to pay us a total of £500. The cash they will actually pay us would be £350. Now, if I start posting that as double entry, we would therefore have a debit to cash or bank for the £350 they've actually paid us. Now, just balancing that double entry, the credit would be to the sales ledger control account, That would therefore be reducing the outstanding trade receivable. That's paying off what they owe us. But the thing is, they've only paid us 350. They did owe us a total of 500. If we only posted this credit to the sales ledger control account of 350, there's still going to be a remaining balance on their account. But they don't owe us a penny. We gave them a discount. So we actually need to further credit the sales ledger control account by the remainder of the £500. You see, that's going to be posting a total of 500 as a credit to the sales ledger control account, effectively eliminating the amount that they owed us because they paid us cash of 350 and we've let them off with the rest. So we need to post the total of the £500 credit. The remaining debit actually goes to discounts allowed. We can't post this to cash because they don't actually pay us the cash. So we have a 150 posting to discounts allowed. And that discounts allowed account is effectively an expense of the business. A debit, part of the debt, that can be an expense. That's an expense of the business because if you allow customers a discount, it's going to cost you money. It's going to reduce your profit. You can see we've actually now got a balancing double entry. We've got a total of 500 on the debit side, 350 to the cash account, 150 to discounts allowed, and a total of 500 on the credit side, which is actually all going to the sales ledger control account, can you see? Now, I could post it as two separate figures, or alternatively, I could just post the single 500 as a credit to the sales ledger control account, because I know I need to eliminate the entire amount they owed us. They have settled it in full, either by cash or by the discount we offered. Well, next transaction is we return damaged goods with a net value of £200 to a credit supplier. Now, this time we're told that this is a net value of £200. Now, that means that the VAT will be 20% of that £200, which would be £40, and therefore the full gross value, including VAT, would be £240. Now, it's that full gross value that I would have owed the supplier. That would be a liability on the purchase ledger control account. But if we've returned the goods, we're not going to pay for it anymore. So the first thing I can do is I can debit the purchase ledger control account by the full gross value of 240. That's eliminating the liability that I owe the supplier. But of that 240, only the net value would have been recognised as an expense in the business. In the original double entry, we would have shown an expense for 200 because we'd be reclaiming the input VAT. So I'm going to have the corresponding credit to cancel that expense. We might post this to purchases returns for the net value of 200. So that's effectively cancelling the debit I would have posted as a purchaser's expense of the net value. Now you can see that that doesn't balance. We need a 40, which you can imagine is the VAT. So posting as a credit to the VAT control account. Why are we posting a credit to the VAT control account? Well, if you imagine the original purchase we made, when we made that purchase, we would have suffered the input VAT, which we'd have been looking to reclaim. We would therefore have posted a debit to the VAT control account to show the asset I was trying to reclaim. But actually, I didn't really purchase these goods because I sent them back. I'm never going to pay for them. So HMRC are not going to allow me to reclaim VAT that I didn't actually end up paying. So this credit to the VAT control account is just cancelling off the input VAT I recognised in the original transaction. And you can see we have got a debit of 240 and a credit of a total of 240. So again, a balancing double entry for our purchases returns there. And then the final double entry, we received a £300 discount from a credit supplier as an incentive to pay an invoice of £700 more quickly. So I owed them, of £1,000 more quickly rather. So I owed them the full £1,000, but I will only have paid them cash of that £700. You can imagine I would have had an outstanding liability of £1,000 on my purchase ledger control account. I got a discount of £300, so I only actually had to pay them £700. Now that means on the double entry, I can have a credit to my bank or my cash. This is what I'm paying them of £700. And that would be posted as a debit to the purchase ledger control account. You can imagine that's a balancing double entry. The debit to the purchase ledger control account is reducing the liability that I owed because I've had the cash payment. But I actually owed the supplier of a total of £1,000, didn't I? If I owed them £1,000 and that was sitting as a liability or a credit, and I only debit it by 700, that will leave a little outstanding balance which I don't actually owe them. So I do need to post a further debit to the purchase ledger control account of 300. You can imagine that means in total I'm reducing the liability by the £1,000 I owed them. The credit is now going to go to discounts received for this 300. And discounts received, well, this is a bit like income. This is a credit. It's a bit like income in my accounts, because if you get a discount from a supplier, that's going to improve your profit, isn't it? And you can hopefully see we do have now a corresponding 1,000 on the debit side and 1,000 on the credit side. The credit side is made up of the 700 credit to my cash account, as I've written them a cheque for 700, and then the credit to the discount received of the other 300. And on the debit side, you can perhaps see I could actually just post the full 1,000 in one go, because both are going to the purchase ledger control account, so I could actually just post the full 1,000 in one go to the purchase ledger control account, because I owed them £1,000, and either by the cash I've paid them or by the discount that I've received, we are getting rid of the whole £1,000 liability. I've cleared the whole amount, haven't I? Now, that's the 4 transactions there with double entry. One thing you might have noticed is it's only in transactions 1 and 3 with the returns where we needed to deal with VAT. VAT is only dealt with on the returns themselves. When we've got discounts, you might have noticed that the double entry, well, that was the discount received, where we had no impact of VAT. And then if I go back to where we had the discount allowed, again, there was no impact on VAT there. So it's only on the returns here that we need to worry about value-added tax.